And good morning once again, options traders. Well, I'm hearing a lot of people talk about vertical spreads, and I've heard some conversations, people talking about, well, if you compare the debit spread to the credit spread, you should just take the one that gives you the better maximum gain or the smaller maximum loss. And as a general rule, that can be okay if we're not going to count the ease of a morph. But generally speaking, if you're going to open a vertical spread and close it as a vertical spread, sure, take the one that produces the biggest gain or, conversely, has the cheapest cost. But that argument can break down once you start getting into higher interest rates. Now, yes, I get it. In today's world, it's really not an issue. But if you start looking at longer dated vertical spreads, it certainly can be. And you can fall into illusions where you think that one spread is better than another, and there might be the same or it might be the opposite answer. And you need to understand this part of option pricing to make better decisions. So let's start off with a little review of the debit versus credit spreads. Let's say that we have the 100-105 call spread trading for 2. So this means if we buy the call spread, we have to spend $2. And if that's true, if we look directly across the board at the 100-105 put spread, we would see that it's selling for 3. So the prices appear different, but they're really the same. And the reason is if we spend $2 here for the 100-105 call spread, it's a $5 spread. Remember, it's an asset. We've talked about that before. It can grow to a value of 5. So if we spend 2 and it grows to 5, that's $3 in our pocket. Conversely, if we sell the 100-105 put spread, sure, it's a credit of 3. This is your maximum gain, but remember this is a liability. This cannot grow to any value at all. It can go against you by $5. So it's a liability equal to 5. So if you're paid 3 and you end up losing 5, then your maximum loss is 2, exactly the same as it is for the call spread. So again, the prices appear different, but they're actually, in this case, identical. So as I've talked about before in other videos, buying the call spread is exactly the same thing as selling the put spread, and conversely, buying the put spread is exactly the same thing as selling the call spread. This is assuming that we don't have any skews in the market. So this is really what the decision comes down to if you're going to make the best choice of buying the call spread or selling the put spread, or let's say choosing between the debit spread versus the credit spread. Should come down to skews, not because of debit or credit. So regardless of which one we choose in this example, whether we buy the 100-105 call spread for 2 or we sell the 100-105 put spread for 3, this is going to be our risk graph. So we've got our bends at 100 and 105. If we spend 2 for the call spread, max loss is 2, max gain over here is 3. That's why we're seeing the diagram line up right there at a maximum gain of 3. On the other hand, if we sold the put spread for 3, we're starting up here with a credit, but we might lose 5, and that means we could fall down here to a max loss of 2. So once again, they would be exactly the same. So yes, the general rule is that if the 100-105 call spread is trading for 2, the same strike, same expiration put spread, or the credit spread, would be selling for 3. So why would we choose one over the other? Well, forgetting about the ease of the morph, the main reason we would choose one over the other is because of skews. And in the market, we might find that these prices don't line up exactly. So for instance, let's say that the 100-105 put spread is selling for a 310 credit. Well, see, now the maximum that we could make on the debit spread is 3, but we could make 310 from the credit spread. So in this case, we would use the credit spread. But you might also find out that the put spread is selling for a credit of 290, in which case now, all things equal, you would be better off with the debit spread. So this is the basic general rule that people use and what I've been hearing a lot of the conversations centered around. However, what I want you to understand from this video is that interest rates can also cause illusions. And to see why, we have to back up to another principle that I've talked about before called the present value of money. And the way that it works is this. Let's say that somebody owes you $100 in 1 year, and the risk-free interest rate is 5%. Well, what's today's value of the debt? A lot of people will say, well, hey, if you owe me $100 in a year, then you owe me $100 today. And that is not true because we are separating these by time. So the way we would solve this is to take the $100 debt and divide it by 1 plus the interest rate. And that comes up to $95.24. And what this means is that you should be willing to accept $95.24 today to settle this $100 debt. Why? Because you could deposit that money and earn 5%, multiplying by 1.05, and that would give you the same $100 in a year. So once we account for the time value of money, we can see that even though we're dealing with different values, they're really the same. $95.24 today is exactly the same thing as $100 in 1 year if the interest rate is 5%. So keep this basic point in mind, and now let's see how you can get illusions with your vertical spreads. So here are some call and put prices. I've put these into a pricing model. We're assuming that the current stock price is 100, interest rates 5%, volatility 20%, and just to make the math easier, 5% interest rates. So under those assumptions, the $100 call is worth $10.33 and the put is worth $5.57. The 105 strike, the call and put are both worth $7.91. So it may be a little curiosity why the call and the put are valued the same, but I've talked about this before in previous videos. Remember that options are valued at what's called the forward price. If the stock is 100 and interest rates are 5%, the pricing model sees the 105 strike as at the money. And so in the absence of dividends, they will be priced the same. But regardless of where the stock price is, if we look at the call spread, in this case, it comes up to a cost of $242. And if we pay $242 and we can make 5, our max gain is $258. Over on the puts, if we were to sell this spread, which would give us the same bull spread, I would be receiving $7.91 and spending $5.57. I get a credit of $234, and therefore that is my maximum gain. So this is where a lot of traders would look and say, hey, look at this. The call option spread, the debit spread, allows me to make a maximum gain of $258, whereas the put spread only allows me to make $234, and therefore the call option spread is better. It must be that there's some type of a favorable skew going over here on the call spread, or an unfavorable one over here on the put spread, and that is not necessarily true. So take a look at what's happening. The difference between these max gains is 24 cents. Where's that 24 cents coming from? Well, it's coming from the interest rate. Remember, these are $5 spreads. If we divide it by 1 plus the interest rate, that is $4.76. What's the difference right here? What's the difference between $4.76 and this $5 spread? It's 24 cents worth of interest. So if you go back to the previous slide, you'll see that the 100-105 call spread had a maximum gain of $258. Now, theoretically, if you're paying a debit spread, you have to dig into your money market to pay for that $258, which means you're now missing out on interest. Or you could also say you are borrowing the money. That's another way of understanding it, financially speaking. So we would have to account for that. You're missing out on interest. How much? Well, let's take the $258 divided by 1.05. It's really worth about $245. On the other hand, the put spread for the credit had a maximum gain of $234, but theoretically you could take that $234 credit that you received today and invest it. So you're doing the opposite of the debit spread. So if we invest $234 at 5% for a year, look what that comes up to, $245. So right there, these two numbers, the $245, we find out that they are exactly the same. So the apparent discrepancy between the $258 max gain on the debit spread and the $234 max gain on the credit spread is due to the interest rate. It's just an illusion that the debit spread must be better, but it's because you're not accounting for interest rates. So keep this in mind, especially if you're using longer dated options or spreads, that the interest rates can cause illusions because there is always a cost of carry, even for options. And if you're not understanding all of the details, you can't be making the best decisions. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.